Winning Resorts. So, Winning Resorts. This is a tricky one because if you look at Wynn, right, well, one, the stock price is down 27% over the past 5 years, so it's been a poor performer the past 5 years. Obviously, they dealt with Rona, there's shutdowns, all that crap they had to deal with, right? Vegas is doing very well right now and probably going to do even better. We got Formula One coming in November. We got the Super Bowl coming in February. And obviously Vegas just puts up Vegas numbers anyways. But those are two like insanely huge like world events that are coming to obviously Vegas. So Vegas is going to continue to put up great numbers. Boston's been doing pretty well as well, right? Macau we'll get to in just a second. There's been a huge change in Macau that's benefiting Wynn in a tremendous way, okay? But when it comes to Wynn, obviously, their revenue growth, everything looks pretty insane right now, right? And the stock's trading actually significantly undervalued because Macau's just coming back. They just finally started to open back up Macau this year, okay? I know, that's insane. Like, China really kept things shut down that long. No, as far as the first half of the year, we got back to 71% of the first half of 2019, okay? So in terms of the first half, we weren't even back to 100% of what the, Macau in general was doing back in 2019. My expectation is second half, we're going to get probably pretty darn close. Based upon some of the numbers I'm seeing out of Macau GGR, I'm going to have to say there's a good probability we're going to get back to 100% of where we were at in 2019, if not over 100%. And that's a game changer for Wynn because their revenue is skyrocketing, their profitability is skyrocketing, their net income, right? Macau's gross domestic product, GDP, rose by 117% year on year in real terms in the second quarter of this year. That's incredible numbers, right? I imagine the third quarter is going to be insane growth and the fourth quarter as well, right? And then that puts us into 24. And keep in mind, this is all going on while China's weak economically. Think about that for a moment. You got youth unemployment super high in China. Everybody's talking about, how bad the economy is in China right now. And despite that, Macau numbers are already starting to come in and be very, very impressive. Now imagine when we lap these numbers, and imagine what the numbers will be next year, and then imagine if the Chinese economy can get in a little better state. Then what are we talking about? So Wynn's one of those stocks I look at, and by the way, they're building actually a huge property in the Middle East, the first of its kind over there, which is going to be a pretty exciting opportunity in that region, obviously, right? So when I look at Wynn, I look at a stock that's actually significantly undervalued right now. Obviously, there's always a risk of recession out there and things like that, but when you're dealing with a company that they already had their worst case scenario. Worst case scenario is not a recession for Wynn. Worst case scenarios were what the company had to deal with for the last 3 years, which was Macau being shut down. Macau was basically shut down 2020, 2021, and 2022. Three years. It was basically shut down. I mean, they would kind of open up a little bit and let some people in, but it was like basically shut down. And so that's off the company now, and that's massive for Wynn. And so that's just another stock that is actually on sale under $100 is pretty attractive for me. Best stock overall, this is a very confusing one, is Elf on a Shelf. We're up nearly 1,300%, and unfortunately, I used to hold almost 10,000 shares of ELF between all my different accounts. Now I only hold 1,000 shares. I wish I held every share of ELF, okay? Stock's done tremendous. A lot of people are like, is this an overvalued stock? Well, I don't know about that, to be quite frank. It actually might still be a good value. Check this out. So, company trades in terms of, this year's numbers, at a PE of about 50. Now, you might say, gosh, that looks so high. Market trades at 20, something around there, right? Well, what if I told you this is a company that quarter in and quarter out kills numbers? Look at this. This is over the last several years of Elf on a Shelf. They beat. They surprise the upside quarter in and quarter out. So whatever you think you're paying for the stock is actually much likely a much lower number. Has been consistent for years with this company. They never freaking miss on revenue. Like, it's ridiculous. For years, they just beat and beat and beat. Like, someday I'm sure they're going to miss, but I don't know when it's going to be. Like, it's insanity, right? Check this out. EPS, over the last several years, they missed one time. That was in December 2021 quarter. That's crazy. Like what are we talking about here? One miss in all these massive beats, and look at it's not just like they're beating numbers. Look at the EPS beats: 92% upside surprise, a 113% upside surprise, a 105% upside surprise, a 126% upside surprise. So Elf on a Shelf is just arguably one of the best, most well-run companies in all of the world. And it's like, what are you willing to pay for a premium valuation for one of the fastest growth companies you'll find certainly in their industry and one of the most well-run companies, period, in the entire world. I don't know a company that's more well-run than Elf. I don't. And that includes Tesla. That includes Meta. That includes Apple, Microsoft. There's no one in the world more well-run than Elf on a shelf. That's a special stock. Not even NVIDIA is as well-run as Elf. Crazy, man. And so at the end of the day, I continue to hold those Elf shares, and I'll continue to hold those because I love that baby. So appreciate y'all joining me. Top 5 best and worst stocks in the public account. Some painful ones and some very, very happy ones. Let's just put it that way. Amazing's on Amazon stock. So Amazon stock actually has had a bad past 5 years. Stock's only up 36% for Amazon. That's a rough 5-year span there. Okay, let's just put it that way. Now, the way you need to think about Amazon's business model, and the way I think about Amazon's business model is this, okay? Because most people, when they think about Amazon stock, the first place their mind goes is like, oh, cool, I'm buying Amazon, the e-commerce business. And they think about all the stuff they order on Amazon, and they think about all those trucks driving around their neighborhoods. All fine, man, all cool stuff. But that's not where your mind really needs to go in regards to Amazon. The first place your mind needs to go is Amazon Web Services, okay? Amazon Web Services, think of it as a backbone of companies. Think about it as almost like the backbone of the internet now at this point in time, okay? Amazon Web Services, the big cloud giant itself. This is where the big profits come from for Amazon overall. I do believe the e-commerce business will build out profitability quite substantially over this next 5 to 10 years, but if you look over the years, it's really, how Amazon's really making their money is really from AWS, okay? Now, with that being said, after you think about AWS and how big that can be 5 or 10 years out, then you need to consider the e-commerce business, right? Then inside that, you need to consider Amazon Prime, because Amazon Prime, one of the biggest paid, if not the biggest paid membership service in the world for something like that, right? Absolutely incredible how many people are signed up for Amazon Prime, and I'm sure the numbers are just going to continue to grow over the years, and they'll be able to command higher and higher price points, as we've seen recently with them going up on price, right? At the end of the day, like once you sign up for Amazon Prime, I've been signed up for Amazon Prime for years, and I can't even consider, even if they were to go up $30 a month, I'm not canceling Amazon Prime. Come on, man, okay? Amazon infrastructure is something they've built out over the last 15, 20 years that's way underrated with the company. You can't duplicate that unless you have, so much money to spend. It's ridiculous. Their planes, their trucks, all over the place, their distribution network, their facilities, their robots, the logistics side. You can't duplicate that unless you have just so much money and know-how. I don't even know who could. The one company that seemed like they might try to challenge Amazon there was Shopify. And even Shopify got into that infrastructure side and they realized, oh, hell no, this is too much, okay? So Amazon now has this super unfair advantage of their infrastructure that's just, in my opinion, one of the most underrated business aspects of any big tech company in the world, okay? Then from there, you need to consider their advertising business that has built out into a giant in the advertising space. Now, when you think about advertising, you really think about Google, Meta, which are the ones you've always thought about, and right under them, now you're starting to think about Amazon. Their advertising business has become a giant, okay? And I'm sure it has a long runway of growth ahead of it, and that's a straight profit. We know advertising brings in straight profits. Look at Google, look at Meta. That's a really exciting opportunity for Amazon, okay? Then from there, you need to consider the fact that they own businesses like Whole Foods and Twitch and others, okay? And so there's so much going on at Amazon. There's so many giant businesses they really own that are just game changers that it's a very exciting opportunity. And obviously, Andy Jassy reminds me of just like Jeff Bezos 2.0. Even some of their, oh gosh, the laugh is the one thing Jassy doesn't have that Bezos has, and obviously Bezos just has a little more stage presence. But even their tonality, even the way they speak between Jassy and Bezos, it reminds me so much of each other. It's unbelievable. And Andy Jassy was a man who really oversaw Amazon Web Services growth over time. He's done a phenomenal job leading Amazon since obviously Jeff Bezos stepped away. Now, in terms of EPS side, okay. And the company looks like it's trading rich. Based upon 2024 numbers from analysts, the company looks like it's rich, right? It trades at a 45 PE. Keep in mind, if you're going to grow EPS 40% or so, and you're expected to grow that over the next few years, that's not a high PE at all, right? If you're a company that's going to grow your EPS 3%, that's a very high PE. If you're growing your EPS like 40%, that's not a high forward P. And we do know, Amazon historically has been known as a company that beats their earnings per share estimates. And so if they can come in with some very nice beats that I believe they'll come in with over this next year, I mean, that's a pretty extraordinary opportunity there, right? Now, keep in mind, on the revenue side, this company has growth for days, obviously, right? And keep in mind, as in terms of analysts, they actually have the company growing way under what they've historically grown. Now, usually Amazon's a company you can think about growing 15 to 25%. Obviously, analysts have gone much more conservative with about 10% growth. So we'll see if that holds up, right? But overall, they should cross over $600 billion of revenue in 24, over $700 billion of revenue in 25, and it's kind of a toss-up between 28 and 29 when they cross $1 trillion in actual revenue. Like, that's an incredible number to just wrap your head around. $1 trillion in revenue, like crazy. That's where this company's headed, right? Now, in terms of myself, this is my Amazon base case, okay? I have been averaging 12% revenue growth over the next several years, which I think is, not too crazy. I think that's pretty conservative. I've been doing about 18% net income growth on average for the company over the coming years. Keep in mind that number is probably low based upon kind of what analysts are expecting here of these kind of like 39%, 42%, 27% numbers. So I might have gone a little conservative there with my net income growth, and that's fine. Now, the company should be able to command in 27 a forward PE or a PE of somewhere that's called 30 to 40. That puts it at about 1.7 trillion to about $2.3 trillion market cap. And that's with a net income margin of only 6%, 6.5%, okay, from my base case. So given what I think this company's doing, the base case around it, yeah, I'm willing to take let's just call it the risk-reward profile of Amazon. And this is another one of those businesses that I can feel comfortable buying Amazon in any economy. If the market's crashing, I can feel comfortable putting money in Amazon. If the market's skyrocketing, I can feel comfortable having money in Amazon. If things are just so-so, I can feel comfortable having money in Amazon. It really doesn't matter. Anyway, I feel comfortable having money in Amazon with the management team there, the business model they had there, the pedigree. I mean, it's phenomenal. So that's Amazon, otherwise known as Amazingzon.